Hey there, hi. Hey, welcome back, everybody. Welcome back. Ed Ponsi here, your FX educator here on behalf of One FX Street. Hey, I'll be here with you for the next 30 minutes, so please stick around and feel free to stick around. I'll be here with you for 30 minutes, and then we'll take a 30-minute break, and then we'll be here together for another 30 minutes. So 60 minutes altogether out of the next 90. And this is your room, so please feel free to ask questions. You can ask pretty much anything. Technical, fundamental, risk management. It can be advanced. It can be basic. It can be a beginner question. It's okay. This is your room, so feel free. You can ask me about stocks. You can ask me about commodities. You can ask me about currencies. I can't guarantee you that I'll know every answer, but I'll give it my best shot. Okay. Good morning, says Carlos. Good morning, sir. Hello, says Al. Good to see you, Al. And Richard says, hi, just ordered your latest book. Hey, thanks, Richard. I appreciate that. Just remember, when you order my book, it's like buying me a beer. So, okay. Aussie USD. Look at the size of that green candle. Do you see that candle? Holy heck. Right? That is massive. And I'm going to take this down to a lower time frame here. Let me take this down to a 15-minute. And we're gonna just try to get inside of this. There's a huge move on Aussie. And now, whenever I see big moves like that, I always try to go back and pinpoint exactly where did this move come from, right? And you can go back here and you can look and see that this move really begins on 7/14, right? So that was Friday, and that was at around the time of day on Friday when news tends to hit in the U.S., when economic news tends to come out, right? So we know it was not the jobs report, right? Because that comes out the first week of the month. But we had a really bad, you can see what's happening here. Aussie's going up, dollar's going down. And if we look around, so the dollar gets crushed here. What happened on Friday was a really bad retail sales number. Really bad. Retail sales expected to rise by 0.2%. And that's a month-over-month number. And instead of rising 0.2, it fell 0.2. And that's month over month. So in a very short period of time, retail sales tanked. And that's retail sales down 0.2, right? And then core retail sales, which means let's take out auto sales, because auto sales account for 20% of retail sales. So let's take that out just in case it's distorting the number. So if you take out auto sales, what happened? It still dropped 0.2%. So it's bad if you include autos, and it's bad if you exclude autos. It's just bad, right? The month, it was just a bad month. June was just not a good month. And this could be a bad sign going forward, could be a very negative thing going forward. Just something to think about, gang. And we shouldn't get too carried away over 1 month. We really shouldn't. But if you look around, right, if you look at Euro US dollar, you probably see something similar happening around the same time of day. So in addition to retail sales, and by the way, there's the same move happening on euro, right? Euro shoots higher. And if you look at the British pound, if you look at the British pound, you're probably going to see something similar. And what this is telling us, by looking at different currency pairs, see the British pound moves higher against the dollar. And so what we learn is it's really not got anything to do with the Australian dollar. It's really got everything to do with the US dollar. Not only was retail sales were very disappointing, but inflation was non-existent. CPI inflation, 0.0 for the month. No inflation, none. Now, you and I as consumers might say, hey, that's great. We'd probably even like it if prices fell. But this goes hand in hand with a lack of retail sales. Imagine you own a store, and all of a sudden, nobody's buying anything from your store. Can you raise prices? No. You probably would even cut prices. And so a lack of retail sales leads to a lack of inflation. If you have a store and nobody's coming in, perhaps you'll have a sale. You will cut prices, right? So CPI, Consumer Price Index, 0.0. But if you take out food and energy, the increase, it increased, but it only increased by 0.1 in June. This is not good. This is not what we want to see. Retail sales are falling and prices are flat. Now, all of this could be just one bad month. Anyone can have a bad month. It could be an anomaly. It could be any number of things. We don't freak out over one bad month, but what you begin to look for is, okay, now next month, everyone's going to be watching very closely. The really bad thing about the retail sales number is this. Not only did we get negative 0.2 for June, but they revised May, and you know what they came up with in the revision? Negative 0.3. So we actually have 2 consecutive declining months of retail sales. Negative 0.3 in May, negative 0.2 in June. Boy, oh boy, the Fed, just as the Fed is raising rates, people have completely stopped buying everything. The Fed just gets it exactly wrong every time. It's amazing. And retail sales, not only was retail sales 0.0 in June, but the revision for May, negative 0.1. Prices are actually falling overall over the past 2 months. So sales are falling, prices are falling, interest rates are rising. Bad combination. And suddenly, I don't think you're going to see any more rate hikes in the U.S. This is not looking good, right? So anyone can have one bad month, but now you look at the revisions, it's not one bad month. It's at least 2 bad months and counting. So now we're all going to be looking really closely next month to see if next month is if we have a 3rd bad month for retail sales. I mean, how can you have a strong economy if no one's buying anything? How do you do that? Right? We know all the stores are closing in the malls, right? But at least people are buying stuff on Amazon, right? But if they stop buying stuff on Amazon, well, I guess we're screwed, right? That's pretty much it, right? That's it. We got nothing. We got a whole bunch of nothing going on. So anyway, not looking great out there, gang. So the dollar continues to get rocked. It's not just the fact that Other countries are now raising rates, as we discussed last week, like Canada's raising rates. But the U.S. economy is now looking like, all of a sudden, looking like junk. You know, it was looking pretty strong, and then suddenly not looking so great. Look at that dollar. 95 on the dollar index, and just going lower and lower. Just looks brutal, man. Just brutal. So there's a quote I wanted to share with you, because I covered this one. And you're going to say, Ed, this didn't hit your stop. No, it did not hit my stop. So what are your thoughts on U.S. Open? Well, let me tell you what I did. EURUSD did not hit my stop. It did not get above 115, but I covered it anyway. Because I just think it's going to go. I think this is going to go higher now. The trend is moving higher. The fundamentals seem to have changed. The sentiment seems to have changed. And I'm on the wrong side of it. So I'm taking a small loss. I took a very small loss on this, less than 2%. If this had hit my stop, it would have been a 2% loss. As it stands, I took less than 1% loss. There's a quote I want you to consider. It's not how right or wrong you are, but how much money you make when you are right and how much you do not lose when you are wrong. Who said that? I'll say it again. It is not how right or wrong you are, but how much money you make when you are right and how much you do not lose when you are wrong. I'll tell you what, this quote is by a person who is still alive today, a very controversial figure, not just in trading, but outside of trading as well. Not one of my favorite people, I will tell you that. And Soros, yes, that comes from George Soros. And, but it's very true. And I want you to consider this. There are two separate trades that I had open. I closed this one. Two separate trades that had a potential loss of 2%. This had a potential loss of 2%, but I closed it with a loss of less than 1%. And I was exactly thinking of this quote. I said, why should I lose 2%? Because I don't believe in this trade anymore. I don't. I'm long the dollar, and I'm short the euro. But the euro's trending higher. And the U.S. economy looks like it's fizzling out. And the rate hikes look like they could be ending. And, you know, rate hikes make the dollar go higher, and that's over. That could be over based on the data that we're seeing. So if I'm wrong on this, why should I lose 2%? Why shouldn't I lose 1% or less? Okay. So I took my lumps for less than 1%. I figured, why not? Right? Now, on the other hand, on this trade, also had a maximum loss of 2%. Aussie yen. The stop was close to not even 40 pips. If a 40 pip stop is 2%, and you're now up 400 pips, then you must be up how much percentage-wise? In other words, if your stop is close to 40 pips, and that's 2% of the account, your original stop was 40 pips, and that's 2% of the account. You are now up 400 pips. If 40 pips equals 2%, then 400 pips equals what percent? Your account is up how much percent? If 40 equals 2, 400 equals 20, correct? We risked 2%, 37, looks like 37 pips maybe? Not even 40 pips. Al says 20, exactly. But you're up 400 pips on this trade as of now. That's a 20% gain. You risked 2% initially. You're not risking 2% now. But initially, your risk was 2%. It's now a 20% winner. You've increased your account by 20% on one trade in less than a month. So you've got one trade that's up 20%, and the other one is a loss of less than 1%. Again, it's not how right or wrong you are, but how much money you make when you are right and how much you do not lose when you are wrong. Just something to think about, right? So getting back to the euro, why be short? This is now looking very much like the same trade. Why would I want to short this? Bounce, 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 bounce on the 10-day exponential moving average. This to me looks like it's a buy on the 10-day exponential moving average at this point. Why on earth would I short it? It makes no sense to me. All right, so not anymore. It used to. But back when I shorted this, everything was different. Now, suddenly, the U.S. economy looks like it's in a lot of trouble. Now, the outlook on interest rates is very different in the U.S. and in Europe. Europe looks like not like they're going to raise rates anytime soon. But I'm willing to bet the U.S. is about done. So to me, this looks like a buy. Not only does that look like a buy, but you could buy this and it has absolutely nothing to do with the Aussie yen trade. I mean, it's Euro USD. There's absolutely no correlation between this and Aussie yen. So you could have them both going, and you know, you could be long Euro USD and long Aussie yen at the same time, and there's zero correlation between the two, which is nice. Question from Al, is the UK CPI the next data mover? Definitely it could be. Let's take a peek. Take a peek around out there. UK CPI could be a mover. You know, CPI reports don't always move the needle. First of all, analysts seem to be pretty good at predicting these. They seem to be pretty good at predicting these. And for that reason alone, they usually come in pretty close to the mark on expectations, and therefore you don't get big moves out of them. But UK data in general, the pound has been pretty volatile. That alone makes it interesting to me. Just the volatility alone. But this is also I like the way this is beginning to trend, the euro. One thing I have not liked about the euro has been, remember how the volatility was dropping? It's only moving 70 pips per day, which means it's really not great for intraday trading. British pound is moving 91 pips per day, and it actually got up as high as 131. That's the highest that I can recall it, well, in close to a year. Now, is that really British pound strength, or is it dollar weakness? I'd probably attribute that as much to dollar weakness as anything. But you do have three hawks on the Monetary Policy Committee. Right? But that's a nice looking breakout. Technically speaking, that green line, 130.50, is a buy point for British pound. See all these spikes up to that green line? That's resistance, resistance, resistance. Should act as support now. So British pound bullish. Looks like 130.47. We got close to that today. We got down to 130.57 as a low. So maybe we'll come down a little bit more. But it got very, very close to a buy point today, the British pound. As far as Euro USD, my buy point for Euro USD is 114.13. 114.13 as of right now. That's the location of the 10-day exponential moving average. 10-day exponential is where I would be looking to buy this. I covered my short, live to trade in another day. Let's cover dollar yen, says Richard. Let's take a peek. This was flowing very nice up the 10-day exponential. Look at that beautiful flag, too. Bullish, bearish, bullish, and bouncing off the 10, but all good things come to an end eventually. Just like our Aussie yen will eventually come to an end. Dollar yen came to an end here. Broke through the 10-day moving average, 10-day exponential moving average, and took out the stop undoubtedly. If it didn't hit the stop on these two candles that poked through the moving average, it definitely got it on Friday. No question about it. A decent little run in the interim here. Does this mean it's automatically going to trend lower? Really don't know. I wouldn't make that assumption. I'd need to have some sort of evidence at first. But it's kind of interesting. Just looking at this chart, there's been an awful lot of activity surrounding that 10-day moving average, both on the upside and the downside. You see it catch a little bit of bounce here, and then it takes off. Then it breaks below, and now it becomes resistance, 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 pokes through here and gets you. Breaks through cleanly, and it becomes support, 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 support. Breaks through here. Will it become resistance? It's anyone's guess. It's way too early to make that call. I prefer to see some evidence first before making that judgment. I think the problem we might have with this pair is yen is not the strongest currency out there, and the dollar is weak as well. So we've got weak against weak. And it's going to be hard to get a good long trend going on weak against weak. They're too evenly matched. Whereas Aussie yen, right, you've got strong against weak. And boom, right, we've got strong against weak here. And it's just one side is just kicking the daylights out of the other side. That's exactly what we want to see. Got a question coming in on over here. Carlos talking about the euro says it is indeed a buy, but do you also believe the euro is high on the curve as it approaches 116.16? Well, looking at a trend, I mean, just remember that trends, the whole point of a trend is you would be buying a pullback. Right now, euro's at 114.67. This needs to come down 50 pips in order to buy. So it's not a question of has it gone up too much. The nature of a trend is that it breaks through resistance. And, that's kind of the way that I'm looking at this, is that the nature of a trend is that it breaks through resistance or supply, or however you want to characterize it. And of course, but if I'm wrong, I'm just going to get the heck out. Just like I did on the other side of the trade. Correction might be possible to 112.60 or even 110. That's exactly what I was pretty much counting on up until Friday. And what changed my mind is I began to look at a combination of not just the chart, but the data, right? The economic data, Yellen's speech from last week where she turned really dovish, in my opinion. And you look at these other countries are going to start raising rates. The U.S., I believe, one more bullet in the chamber for this year tops. And then you see that data on Friday and you say, maybe not. Maybe they're done. And it just doesn't look like fundamentally the dollar doesn't have a leg to stand on right now. And meanwhile, that the euro probably shouldn't be as depressed as it is. I mean, it looks way down. It looks like it's come way up based on this, but if you look at it from a different perspective, it's way down. If you look at it from this perspective, I mean, it never recovered from that fall in 2014. We also want to see the presence of some bears before considering a short on the euro as it comes to 116. Well, yeah, I might have been early, as far as my short. I shorted around 114. I may have been a little bit early. I may take another shot at it a little bit higher up. There's a nice resistance area a little bit higher. You see that shooting star? I think everybody's looking at this. Right? I know I am. I think everybody's looking at that. So maybe for the next time, maybe that'll be the next one to look at. Next time buy. But I may have been early. And at the moment, being long the dollar just doesn't feel right to me. The way the data is going and the way that the sentiment seems to be turning. But up here on this line, just above 116, it might make a lot more sense. So yeah, I'm with you. I'm with you on that, Carlos. I may have been a little bit early on shorting it at 114. Okay. Good session, everyone. That's going to about end it for this one, but we're going to have another session very soon. So come back, please, in about a half hour from now, and we'll do our second session of the day. This one just flew by. So much to discuss. And so until then, it's Ed Ponsi on behalf of FX Street. Thanks so much for listening. I'll speak to you again in about 30 minutes. Thanks for listening.